Welcome friends to our channel InfoFin. Today we will discuss about beta of a stock. In this video we will learn what is beta of a stock and its significance, mathematical calculation of beta, difference between alpha and beta of a stock, at the end limitations of beta of a stock. So let us proceed. What is beta of a stock? Basically beta is a measure of stock's volatility in relation to the overall market. More volatility of a stock than the benchmark index is having more beta and vice versa. Now if a stock is having a beta value more than 1, in that case we'll term it as a high beta stock, and if the beta value of a stock is less than 1, then we termed it as a low beta stock. For example, if a stock of beta 0.9 has experienced gains and losses that are 90% of the total benchmark index changes at that same time, a beta of 1.1 means the total return is likely to move up or down by 10% more than the index. A fund with a beta of 1 is expected to move in synchronized with the index. Okay, next, how the beta is calculated. Now beta is calculated as beta is equals to covariance of x and y, that means covariance of x comma y divided by the variance of x. Now what is x and y? Y is the return of your portfolio or stock, which is termed as dependent variable, and x is market return or index return, which is called independent variable. Now what is variance and what is covariance? Variance is the square of standard deviation. We know standard deviation is a statistical tool which measures the variability of the returns from the expected value or volatility. It is denoted by sigma. And covariance is a statistics that measures how two variables varies in between them. So this is a simple formula of beta, and again it is covariance of x comma y divided by variance x. Next we move on to difference between alpha and beta of a stock. In previous video we have discussed alpha, and if you did not see that video, you can go and watch the video before watching this beta video. Now main difference is that beta is a historical measure of volatility, and it measures how an asset, it may be a stock or ETF or portfolio, moves versus a benchmark index move. Whereas alpha is a historical measure of assets return on investment compared to the risk adjusted expected return. That means beta is dealing with historical volatility, whereas alpha is dealing with the assets return or investment return. Then as everything has some positive thing and also similarly has some negative sides also, those are the limitations of beta of a stock. Number one, beta is useful in determining the security short-term risk for analyzing volatility. It is used for determining the short-term risk, so it cannot be a good tool for investors. That is why it normally calculates the historical volatility, and in case of investing we need to look after the future volatility also. So it is not very helpful for the investing purpose, since it is denoting the present situation in compared to the historical volatility. It does not factor in any new information of the market. In a beta of a stock we may have the value 0.1, 0.9 or 1, but it never correlates with the news which may come or which already is going on in the market. So it doesn't factor out the news or any speculative movement of the market. Then beta is also less useful for long-term investment, as I already told, since a stock volatility can change significantly from year to year depending on the company's growth stage and other factors and fundamentals also. So in the investment purpose, beta is not a good tool to look at. So friends, this is it for beta. One request, if you have learned something out of it, you can like, share or subscribe our channel. Your one like make us motivated for making other videos also.